Ladies and gentlemen, good day and welcome to the Ganesh Consumer Products Limited conference call hosted by Go India Advisors LLP. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note, this conference is being recorded. I now hand the conference over to Ms. Garima. Thank you, and over to you, ma'am.
Thank you. Good morning, everyone. I'm Garima Singla, and it's my pleasure to welcome you on behalf of Ganesh Consumer Products Limited. Thank you for joining us today for the Q2 Financial Year 26 earnings call. This call is being hosted by Go India Advisors. Please note that today's discussion may include certain forward-looking statements. Therefore, they must be viewed in conjunction with the risks that the company faces. Today on the call, we are joined by Mr. Manish Memani, Managing Director, Mr. Amit Tapadia, CFO, and Mr. Narendra Mishra, CS and Compliance Officer. I now invite Mr. Manish to present the company's business outlook and performance, after which we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Garima. Thank you and good morning, everyone. I'm Manish Memani, Director, Ganesh Consumer Products Limited. It gives us immense pleasure to welcome you all to the maiden earnings conference call of Ganesh Consumer Products, which is our very first as a listed company. On behalf of the entire Ganesh Consumer family, I would like to extend my heartfelt gratitude to all investors, partners, employees, suppliers, and stakeholders for their continued trust and support. When we began our rather humble journey, our vision was simple yet very ambitious: to bring authentic, high quality and affordable food staples to every Indian household. What started as a humble, modest, local packaged staple foods brand, today we have evolved into an integrated consumer product company with a strong and growing presence across sattu, spices, flours, powders of all types of cereals and pulses, and ready-to-cook blends. Our story has always been about the balance between tradition and transformation, staying true to our roots while embracing modern systems and processes. From our deep sourcing networks spread across Uttar Pradesh, Madhya Pradesh, Bihar, Rajasthan, and some parts of Western India also, to a robust distribution engine powered by 360-degree marketing initiatives, this blend of the old and the new has been the foundation of the growth. Over the past few years, the transformation has been remarkable. Between financial year 22 and financial year 25, our revenues grew at a CAGR of over 18%, accompanied by steady improvement in profitability and return ratios. Even through periods of commodity inflation, weather disruptions, and competitive intensity within the industry, we remained resilient and consistently profitable, a reflection of our operational discipline and consumer trust. A defining milestone in this journey came earlier this year with our successful IPO on the BSE NSE platforms, a proud moment for every member of Ganesh Consumer family. The fresh issue of 130 crores raised through the IPO is being strategically utilized to strengthen working capital, optimize production capacities, expand distribution reach, and invest in brand building initiatives. This listing is not just a financial event, it's a renewed commitment to our transparency, corporate governance, and long-term value creation. Financial year 26 marks a proud new chapter as a listed entity, and I am pleased to share the Q2 financial year 26 financials in which we attained one of our highest ever quarterly performance. Revenue from operations stood at 2,387 million, up 7.2% year-on-year and 17.6% sequentially over quarter one of 26. For H1 financial year 26, revenue grew 7.1% year-to-year to 4,416 million. Gross margin rose from 24% year-on-year to 621 million, with an expansion of 350 basis points to 26%, led by improved realizations, sourcing, and supply chain efficiencies. EBITDA also grew 24.7% year-to-year to 239 million, with margins improving 140 BPS to 10%. PAT for the quarter stood at 110 million, up 17.3% year-on-year, while H1 PAT reached 207 million, demonstrating the strength of our business model and operating leverage. Our performance this quarter was broad-based across categories, reaffirming the power of our diversified product portfolio. B2C staples, excluding Sattu, grew 15.4% in value and 6.4% in volume, supported by festive demand and shifting consumer preference toward packaged food products. Spices, a new launched, emerged as a star performer, registering 23% year-on-year growth, driven by product diversification, deeper market penetration, and enhanced brand visibility. While Sattu saw softer growth due to a shorter summer season, we remain confident of recovery as seasonal patterns normalize. Our e-commerce and quick commerce channel continued their strong trajectory, growing 97% year-on-year, underscoring the success of our multi-channel strategy and growing digital adoption among consumers. Most importantly, this quarter also reflected the strength of our brand equity, which we were able to effectively pass on calibrated price increases to consumers without impacting demand, highlighting the trust, loyalty, and pull factor which we have built across markets. Operationally, H1 FY2026 did see some near-term moderation due to extended monsoons and softer rural sentiment, yet underlying demand remained healthy and momentum picked up strongly towards the end of Q2, especially ahead of the festive season. Over the last 6 months, we have continued to strengthen the building blocks of sustainable growth. On the distribution expansion, our network now covers more than 350,000 retail touch points across traditional, modern, and digital channels. On portfolio diversification, with more than 200 SKUs, we now cater to a wide range of regional and national taste preferences. On brand investments, focused efforts on digital marketing, in-store visibility, and influential-led campaigns are driving a stronger consumer connect and recall. On supply chain resilience, process standardization and sourcing optimization continue to improve our cost efficiency and quality consistency. Following the IPO, we took decisive steps to strengthen our balance sheet. We have repaid 970 million of debt, including 600 million through IPO proceeds and 370 million via promoter group holdings re- repayment which was due as intercorporate loans. This has significantly reduced finance costs and improved profitability, setting a solid foundation for our future growth. Further, as a part of our commitment to rewarding shareholders, the board has declared an interim dividend of rupees 2.5 per share and approved a revised dividend policy with a payout ratio of 25 to 50%, aligning with our strong cash generation and prudent capital allocation. In line with our long-term sustainability roadmap, GCPL has partnered with Rooftop Renewables to implement a solar power project across 5 facilities. This initiative will not only reduce our carbon footprint, but also lower power costs by approximately 0.65 million annually from financial year 27. Though it is a small amount, yet meaningful step towards a greener future. As we look forward, the second half of financial year 26 and beyond, our strategic priorities are clear and focused. Scaling the B2C portfolio with sharper focus on our core categories and value-added extensions, deepening distribution in existing and new geographies, alongside strengthening our modern trade and e-com presence, investing in brand building and data-driven demand planning to enhance consumer insights and operational agility, maintaining working capital discipline and driving margin expansion through operational excellence. With capacity expansion underway, strong fundamentals and favorable tailwinds from formalization in the staples and packaged food sectors, GCPL is well positioned for sustained profitable growth, creating enduring value for consumers, suppliers, partners, and shareholders. Before I conclude, I want to extend my deepest gratitude to all our employees for their relentless commitment, our suppliers and distributors for their collaboration, and our shareholders for their confidence in our vision. This is just the beginning of our journey as a listed company, and we are determined to build Ganesh Consumer Products Limited into one of the India's most trusted and admired packaged food staple companies. Thank you, all of us, for joining. We can now open floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tanmay Raveri from Finterest Capital. Please go ahead.
Hello, sir. Good morning. Firstly, congratulations on your first ever phone call. Sir, I have a couple of questions. So, currently in our portfolio, we have around 200 plus SKUs, which are spread across 40 categories. So, could you share the current revenue split between the core wheat and gram-based derivatives like atta, besan, sattu, and the new categories that we have, spices and instant mix?
Thank you, Tanmay, for connecting with us. So I am handing over for this figure numbers to Amit.
Yeah. Good morning, Tanmay. Amit this side. So the atta, which we call it as wheat flour, forms around 35% of the revenue, 33 to 35% of the revenue. The value-added product segment, which includes gram-based and wheat-based flour, which is maida, suji, dalia, besan, and sattu. This constitutes close to 60% of our revenue. Now, the third category which we classify the other portfolio is the emerging products, wherein we include spices and other ethnic flour, which forms around close to 5 to 7% of our revenue.
Okay, thank you so much, sir. So my next question was that emerging categories like spices segment. So we have clocked down 50 plus crores in this in FY25. So how do we see the growth trajectory in this segment, in this category is evolving over the next couple of years? And what will be the core factor that will drive this margin expansion?
Right. So as our expectation on the spices, a new launch category for year financial year 25-26 was nearly 40 to 50 crores rupees. And we are there present with the entire basket of whole spices, CTC powdered spices and blended spices. Now, as you know, spices is a regional story. The category itself is a regional story pan-India. And we are optimistic with our long research and understanding on the blended spices and powdered spices, which suits to the palate of Bengal and Eastern India. We look forward to have a wider distribution. We look forward to have a wider distribution across Bengal and Eastern India. And the market size of packaged spices itself is very big, which is nearly 6,000 crores of Eastern India. So with the help of our current supply chain and our knowledge on the sourcing side, and we are ourselves, we are manufacturing the spices. In the coming years, we look forward, in this year also, and in the coming year also, we look forward to expand our revenues on the spices side. Now, as you know, spices itself, the EBITDA margins of the spices category is overall better than the core category. So when I say core category, it is wheat derivatives and gram derivatives. So once the revenue rises with the more distribution, deeper distribution, the margins will also increase. As of till to date, we are to scale up this vertical, and we are seeding this category with lesser margins. But once we reach a scale, our margins will also improve along with revenue.
Thank you so much, sir. It was very detailed answer. I really appreciate that. Sir, this quarter, I see our inventories have risen approx 3 times than the March numbers. So can you throw lights on that?
Yes. So I would like Amit to take this forward.
Yeah, so Amit here. So our inventory level increased as compared to the March numbers because the inventories of raw materials, which includes wheat, gram and spices, were increased. We have to consider a couple of things here. In the previous year, the prices of wheat and gram had increased close to 25%. Now, considering the sharp price increase in the previous year, we as a strategy, we decided that we will buy bulk of the overall annual requirement in the first half of the financial year, which resulted in increase in the inventories of raw material. Now, going forward, towards the end of this financial year, which is FY26, the inventory level will come down to the levels we reported in the previous financial year.
Okay, so it will average out by March numbers.
Yeah. And the benefit side of this is we have enough inventory in hand, and this will facilitate us to maintain a healthy margin and maintain a consistent supply in the market in the next 2 quarters.
Okay. And one last question. If you could just throw some lights on what kind of growth are we looking for this year and probably next couple of years, and what will be the sustainable EBITDA margins that we aim for?
So, Amit, this side. So, we feel that we'll be able to have a annual growth rate of 12 to 15% this year. And going forward, we will maintain a growth rate of around 15 to 20% on the revenue side. And on the EBITDA side, we feel that anywhere between 9.5 to 11% we'll be able to deliver.
So this year, if I'm not wrong, we can clock around 950,000 crores revenue.
Yeah. So on the near term, commenting on the specific numbers will be difficult, but we feel that we'll be able to achieve a growth of around 12 to 15% this year.
Okay. Thank you so much, sir. Wish you all the best.
Thanks a lot.
Thank you, sir. The next question is from the line of Pritesh from Lucky Investment. Please go ahead.
Yeah, hi. So a little bit on since it's the first call and then we see the half-yearly balance sheet as well. So the interest cost that we see this year, is it specifically linked to this inventory purchases that you have done, and hence the interest cost? And is that the interpretation I should do, and how should we look at the interest cost number incrementally? That's my first question. I'll ask, once you are through with this question.
Yeah. So the interest cost, as you, Amit this side, as you rightly pointed out, interest cost has increased in the first half of this financial year because of increased short-term borrowings, which is directly in relation to the increase in the working capital requirement linked to the procurement of raw materials in the first half of this financial year. And as we highlighted that we have repaid close to 97 crores of the short-term borrowing, partly from the IPO proceeds, close to 60 crores, and remaining from the 37 crores intercorporate loan, which was repaid by the promoter group. So currently, if you ask me, the loan amount is close to 58 CR in the book as of now, as of today. And going forward, we feel by the end of this financial year, the debt levels will be zero. And the interest, in line with, as we have repaid the loan, the interest will also go down in the coming 2 quarters.
So which means if your annual interest that you used to pay in the past was about 5-7 crores.
So last year it was in that range. This year we feel it will be close to 10 to 11 CR.
Thank you. The next question is from the line of Naveen Trivedi from Motilal Oswal Financial Services. Please go ahead.
Yeah, good morning, sir. My first question is, was there any impact of GST transition for the quarter? And if that is the case, then how much impact was there in the quarter 2? And also on the GST side, how has been the GST rate reduction has impacted our kind of a portfolio, if that is the case?
So, hi Naveen, Amit this side. So, 99% of our product portfolio had a GST of 5% before, and hence there is no impact because of the rate change on our category. However, we feel that the sentiment the consumer sentiment has become better in this quarter, and that will benefit us indirectly.
And also, considering there was a festive up and down has kind of played out, and East has also kind of a Durga Puja this thing. Any impact of that in quarter 2, and how you kind of seeing that demand trend picked up in the October month, especially last 40 days kind of a trend line. If you can give us some sense about that.
No. So hi, Manish this side. So normally every year this entire festive season in Bengal falls in the same period, either in the months of September or October. So the overall revenue growth of the categories where we operate and play are not very much directly linked to any festive season of the last quarter. But then moving forward, once the winter approaches, then the third quarter and fourth quarter see a spike in the overall consumption by the households. And in the last festive season, largely one category, which is suji, the wheat derivatives, the sale of suji increases as for the consumption of overall consumption in the household for the ritual side, for the dishes they make for the ritual side. So the net, the conclusion is the every second quarter two of every year have the festival season. So overall, around the year we have got we see a same average growth. Nothing specific to the festivals because it's not directly consumed. It is a household category item, and largely in the festive season they move outside the homes to consume.
Yeah, sure, Manish. And since you are giving around 12 to 14% kind of a revenue guidance for this year, that implies that maybe the second half we can expect around 16-17% kind of a growth rate. If I look at your quarter two, excluding Sattu, I think we are already kind of a 15% kind of a growth rate. So excluding Sattu, I would assume that Sattu would have very less mix in the second half, especially in the quarter three. So the other products which are growing in kind of a 15% growth rate, this will kind of a growth rate we can expect in the second half kind of a numbers, correct? Is the understanding right?
Yeah. Hi, Amit here. Your understanding is on point. So as you correctly said, the categories excluding Sattu grew at close to 15.5%. Now Sattu in this part of the country is majorly consumed during the summer season because it acts as a beverage, a coolant, right? So people drink Sattu in the morning and in the afternoon. Now in this, because of shorter summer this time, there was a degrowth in the Sattu category for us. And going forward, anyway, Sattu sales normalizes in Q3 and Q4. And hence we are very much optimistic that we will be able to maintain the growth rate which we achieved in the other categories going forward as well.
And also on the gross margin side, this quarter we have seen close to 350 plus kind of a margin expansion. Can we expect a similar at least margin of 25 to 26% band even for the second half for this year?
Yeah. So Amit, this side. So so there was a margin expansion in this quarter. The reason is better realization across product categories. Then we also enjoyed sourcing goodness, as we already discussed that we procured bulk of our annual requirement in the first half of this financial year. So that helped us that gave us sourcing goodness as well. Now the third reason is, so we have strategically located our manufacturing unit both near to the farm and near to the market. So as a strategy, we are procuring and manufacturing wheat-based products in UP because it is near to the farm and because of the synergy we get in procuring wheat in the state of UP and manufacturing there in our plants in Agra and Varanasi. So that benefit is flowing in the overall material margin for us. And going forward, as we highlighted that we have purchased major bulk of the inventory which is required for the entire financial year. So that will help us to maintain a healthy gross margin in Q3 and Q4.
Sure. And in the other expenses line item, there was a kind of around 26% growth in the other expenses. I would assume this will largely be driven by our the marketing spend, which kind of we are spending.
Yeah. So as a strategy, we launched a consumer scheme on the spices category, wherein we gave 3+1 and 4+1 scheme. Further, we also ran a scheme wherein we gave sugar free with our atta category. So that resulted in now, because that was to be present and to be very much active in the consumer mind space. Also, in this quarter, Imami, which is a FMCG player in this part of the country, they launched Atta, Maida and Suji. Now, to be competitive in the market and to be very active in the consumer mind space, we ran this strategy. Now, if you ask me, over the last 5-7 years, many brands have launched similar products in this category, which includes Patanjali, Adani, Wilmar, Fortune. But we were able to maintain our market share, and we hold the same perception here as well, that going forward, means it is a matter of time in 3 to 4 quarters, we will be able to maintain the market share with our 360-degree marketing initiatives. And as you asked, the overall increase in the spend in this quarter and in the first half is due to this selling and distribution expenses. Yeah, and further, the second reason was the festive season. We wanted to be active, very much active in the Puja Pandals in Calcutta and in the nearby region during Durga Puja. In Q3 and Q4, obviously the spend will be a bit lower as compared to Q1 and Q2. Yeah, but we will be very active in the market in terms of marketing initiatives.
Yeah, thank you so much, Amit and Manish. That's all from my side.
Thank you.
Thank you. The next question is from the line of Pritesh from Lucky Investment. Please go ahead.
Sir, just an observation for the last year, the H1 and the H2 is a completely different performance for you, where H2 had lower margins as well. So, and on the other hand, in H1 this year, you are off by your CAGR growth. Your CAGR growth was plus 15%. For H1, you are at about 7%. So, first of all, will you revert back to your CAGR growth in H2 and this year basically? And why is it that the margin is substantially lower last year, being the first conference call, and we just want to understand the seasonality, if any, in all these observations that I am putting. One is the growth and the other is the margin number. So if you could give some assessment of how H2 will look like.
Right. Thank you, Mr. Pritesh. For this side, Manish Memani.
Hello,
So, due to this year, due to monsoon, shorter summer, and the extended period of monsoon, this year, the sales target of Sattu was not achieved. Other than Sattu, as we mentioned, exclusive Sattu, we have grown at 15%. So I think we are on line in H1 also on revenue growth other than Sattu, and the reason for Sattu degrowth is very clear. Now, if you see on the coming 2 quarters, that is quarter 3 and quarter 4, which is largely in which Sattu is largely not consumed due to winter. Mm-hmm. So and the inventory, as you asked in the last question, the debts have also increased. The working capital has increased due to the high inventory, which will be a blessing to us in the coming quarters. So we can leverage our inventory for 2 reasons, for 2 points. One, to have a revenue growth because we will be in a position, a better supply chain on the RM side and a bit consoled on the inflation side. And second, the margins will also increase because if you see the last 2 quarters, as you rightly said, last year quarter 3, the PET was only 3.6% and the quarter 4, it was only 2%, which was largely due to the spike in the RM prices of wheat and gram both. And this year, we are in a position to leverage that because we have got enough inventory with us. So we look forward to have the same margins in the range of 4.5 to 5% in the coming 2 quarters.
Okay. Would you be able to comment on the operating margin will the operating margin in H2 be similar to H1?
So Amit this side. So operating margin, as we said, the gross margin has improved for us in the first half of this financial year, and we feel that we will be able to maintain a similar gross margin in the next quarters. And going forward, since the volume is increasing and we are analyzing the overall production into various plants in Agra, Varanasi and Calcutta, that will give us operational or capacity benefit also. So going forward, we feel that our operational margin will be in line with our Q1 and Q2 numbers of this financial year.
Okay. And my last question is on the slightly longer CAGR growth, so beyond FY26. So we've been growing at a strong number between whatever 15 to 20% CAGR. So if you could comment on incremental CAGR and the key drivers to that CAGR, if you could enumerate the same.
Right. So, as our historical CAGR growth, though the historical CAGR growth also had some bottleneck with the launch of, in last couple of years, number of companies has came into this space, as Amit mentioned, like Patanjali, like Fortune, and like Parle-G also. Amul is also trying in some part of country. So, but then still we have kept our market share intact. Rather, we have grown in the history. And as Amit mentioned, with the Imami, which is a big player in this space, in the oil space, they have also launched wheat derivatives this last quarter. But then still, we are very bullish, optimistic and hopeful to keep our market share intact, one, and continue growing with the same pace, with the same CAGR in the coming years. Again, another important point is with the bottom line growth also. So we will like to continue our revenue growth with a good PAT margins. And we are hopeful we will able to do this. Reason being, the overall manufacturing is done largely in our space. Most of the players rely on third-party manufacturing facilities. In our case, the entire manufacturing, which is in-house. So the captive production helps us on the supply chain one and on the bottom line growth two. So with the help of these two, we will continue growing. And for revenue growth, we are going to launch in Bihar and Northeast with the start of our Agra manufacturing facility on Atta side, which is due to be done in this November itself. So the balance 4 months is going to see the advantage of revenue from our Agra for the newer geographies like Bihar and Northeast also.
Okay. And what is the capacity utilization and the capex number? I think you have a substantial capacity, right? You need not put up capexes.
So hi, Amit this side. So currently the capacity utilization will be close to 60+%. And if you see at a product level, so Atta has a higher capacity utilization. That's why we decided to install Atta plant in Agra, and it will be active from November. For other categories, we have enough headroom to expand with the same facility. And the capex, the additional capex which is planned as a part of the object of the offer, that is to backward integrate the besan and sattu manufacturing, which will result in consistent quality throughout the year and obviously better margins.
Did we initially call out the dividend policy? Have we formulated anything?
So in the board meeting, this board meeting which happened yesterday, the board has approved the dividend policy wherein the payout has been maintained at close to 25 to 50% of the PAT, of annualized PAT. So we believe that, and also if you see the history of last 6-7 years, we have maintained a dividend payout ratio of close to 36%. And in line with our historical trend, we endeavor to pay dividends to our valued shareholders in the similar lines. And hence we have kept a policy. We have maintained a policy. We have introduced a policy, and which got approved by the board yesterday, that we will maintain a dividend payout ratio of close to 25 to 40%, in the range of 25 to 50%.
Okay. Thank you very much, sir. All the best.
Thank you, sir.
Thank you.
Thank you, sir. The next question is from the line of Vijay Jangir from Systematic. Please go ahead.
Hello. Good morning, sir. Thanks for the opportunity. Am I audible, sir?
Yeah. Morning. Yeah.
Sir. I just wanted to know about the margins. How high our margins are in B2C in comparison of B2B. Are our margins lower in B2B category comparing to B2C? Like, I just wanted to know, if B2C is 10% margin we are making, then how much margins we are making in B2B? Same goes to with general trade and e-commerce or our modern trade channels. I wanted to know about the margin.
Yeah. So, Amit here. So the continued focus of the organization is on the packaged flour segment, which we call it as B2C segment. Now, B2B includes sale of byproducts and co-products, which are getting manufactured during the manufacturing of our finished goods. The prime focus again is to be active in the B2C segment. So the B2C segment, and we track the segment-wise margin at a gross margin level. So the B2C gross margin for this quarter is close to 29%, and the B2B margin is close to 3%. So the focus is on the B2C category, and we are hopeful that we'll be able to drive home a gross margin of close to 28 to 29% in the complete financial year, FY2026.
And
your question, one more question. Yeah. On general trade margins and the e-commerce margins. So, general trade is close to 85% of the overall B2C sales, which is on cash and carry basis, and remaining 15% is modern trade. Now, the margins, we are billing the modern trade customers at a rate which is similar to the rate at which we are billing our distributor in the general trade margin. So that way, the gross margin is similar in both the space. Just that in case of modern trade, we are not paying any additional commission, which we are paying in case of general trade to our CNF agent. So that way, if you see at a bottom line, the margins are better in modern trade as compared to general trade.
Okay. Thank you, sir. And another question related to emerging categories. As we are growing at a CAGR of more than 65% since FY23. So any regional brand acquisition or any capacity-led expansion we are looking for in this category, that is emerging category?
Yeah, Manish this side. So as of now, enough capacity is with us, and with the advent of new capacity creation in our Agra facility for whole wheat atta, which is going to start in November. In near future, we don't see to augment our capacities. This is one. Number two, of course, we look forward for merger acquisition in this side of country, and in our addressable agencies. If we find any good opportunity at a good price, we look forward for a M&A activity.
Okay. Thank you, sir. And one last question. Our margins are highest in emerging categories than value-added products and carrier products, right?
So, if you see the gross margin, on a gross margin level, the gross margin is higher in value-added products, And in the emerging category, currently, as sir said, we are seeding the spices category. So there we have kept a very aggressive margin so that we are very competitive in the market and we want to expand the distribution network. So, going forward, if you see at a category level, obviously the emerging category command a better gross margin as compared to the value-added category and the wheat plus category.
Okay. Okay. Thank you so much, sir. Wish you the best. Thank you.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, to ensure the management can address questions from all participants, please limit your questions to two per person. If you have a follow-up, kindly rejoin the queue. The next question is on the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good morning, team, and thank you for the opportunity. So my first question is that is it possible to quantify what is the first half revenue of spices and what is the kind of gross and EBITDA margin that we are making in this business? And related question is that maybe in the next 3 years, what is the plan on this category?
So Amit this side, in spices category in quarter one, we have grown at close to 70%, 68-70% because of the lower base in the previous financial year. And in this quarter, which is Q2 of this financial year, we have grown at close to 23%. Sorry?
Revenue, absolute revenue, what would be the absolute revenue in first half in spices?
So in the first half, the revenue will be close to 16 to 17 crores in the spices category.
And margin?
Margin will be in line with the emerging categories. As we said, we are seeding the category, so this is not the margins are not a very stable margin in case of spices because we are running consumer schemes, so it will be close to gross margin only. Since we are running the consumer promo scheme, it forms part of gross margin only. So that way it will be close to 20%. And but we feel that the spices category commands a better margin, which we anyways as compared to the previous financial year we have improved the gross margin in spices, and going forward we will be able to achieve a level wherein which is in line with our peers.
So we look forward to have gained the market share in spices in near-stable future. So we want to rake up the entire category in this part of country. So it cannot be done alone only with the distribution and the quality. Initially, we need to have a reach in the kitchens. And I think other than distribution and quality, we need to play on the entire 360-degree marketing, sampling. At least the consumers should sample us first. Then only in the future they will be able to differentiate and reward us with the better margins.
And sir, to basically make this a far more profitable business, what level of revenue do you think can one needs to achieve? Meaning at a 200 crore revenue, can we become a 35-40% gross margin company in spices, or is 200 crore a smaller number?
So we feel and considering the internal target which we have, so going forward in couple of years, we feel we will be able to have a revenue of close to 100 crores on the spices category at a gross margin of close to 30 and 35%.
Okay, even at 100 crores, you can make decent gross margin.
At 100 crore and the gross margin of 30 to 35%.
So my second question is that if you look at your second half last year, the EBITDA margins is fairly low at 6.8%. So is it typically seasonality as lower share of sattu, or there was something abnormal in the second half last year?
Yeah. So Amit, this side, as we highlighted that there was a sharp increase in the prices of raw materials, which is wheat and gram, in the second half of the previous financial year, and it is a public data. So that way, that affected us the gross margin as well, and which flowed down to the PBT and PAT. So the PAT for Q3 was close to 3.6% in the previous financial year, and Q4 was close to 2% as we reported in the previous quarter. So that was the only reason, the sharp increase in the raw material prices of wheat and gram.
So, sir, now that you've procured the raw material in advance, it's visible in your cash flows. So is it fair to say that in the second half, the EBITDA margins will be in line with the first, or how is it?
Yeah, we feel that we'll be able to deliver similar margins in the next quarters because of the levers of inventory which we have in hand as of 30th of September.
And Sattu makes what kind of EBITDA margins? Is it possible, and revenue, if possible, last year?
So the last year Sattu revenue was more than 130 crores, and the gross margin at a VAP category, as I said, we categorize into the VAP category. It is more than 30%. The gross margin.
Great, sir. Thank you very much for the opportunity and all the best.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, we request you to limit your questions to one per participant. In case of follow-up, please rejoin the queue. The next question is from the line of Disha Giria from Ashika Institutional Equity. Please go ahead.
Hi, sir. So my question is regarding how do you fare in comparison to your national brands, since you are going into the expansion and opening Agra facility? What is your market share versus their market share, and how do you ensure your margin stability, be it in the spices, wheat category? Because commodity business, that is why your margins are not stable in general, because commodity business, one time if the prices are high, it does impact. So is there any plan to roll out as a proper FMCG company that would help to stabilize margins in general?
Right. So this side, Manish Memani. So on the margin side, as we have said, last year, in the last 2 quarters of Q3 and Q4 of financial year 25, the prices of raw material of both wheat and gram, they shot up with more than 20-25%. And that was one of the key reasons of our lower PAT margins in the last 2 quarters of last financial year. Moving forward, for that reason, we have increased our inventory level this year to make sure due to any sudden spike in the RM prices, we should not suffer on the supply side as well as on the margin side. Now, moving forward, of course, it is a commodity area, it is a commodity category. But then, we as a brand, or with the strength of brand, with the strength of pull of the customers, and with the help of the distribution network in this part of country, we are in a position, and we have historically passed on whatever the raw material prices increased with the increase in our average selling price also. So maybe the last year 2 quarters were exceptional because it was more than 20-25%. Otherwise, historically, whatever the increase is there, single digit or a smaller double digit inflation in the RM prices, we regularly pass on it to our consumers, and they have accepted this. So this is on the margin side. Looking forward, we look forward to have same margins of H1 in our next 2 quarters. Now, on the market share side, of course, we want to be one of the biggest food category player in Eastern India first, and then we would like to go multi-regional or pan-India. We would like to go more deep rather than going more wide and in geography. And we would like to create more synergical. We would like to step into more synergical agencies also, which we are doing with the help of spices. And in the coming future, we look forward to have some of more categories which are adjacent. Now, with the help of this big basket and deeper penetration in the Eastern India where we operate, I think the market itself of Eastern India is very big, which is 33% population of Pan India. And with the market size, the categories where we operate, the core category, wheat derivatives and grain derivatives market is more than 5,500 crore in Eastern India and 6,000 crore in spices. So I think enough headroom is there to grow in this area itself. Now, on the third answer for your question is on the market share vis-a-vis the Pan-India players. So the Pan-India players in this category is Ashirvad and Atta category, which is 33 to 35% of our total revenue. So we are not in direct fight with any brand because 65% of our revenues come from the other categories where Ashirvad doesn't place. So I think we have a very good product basket for the advantage of our supply chain advantage also with the help of Atta, which is a carrier, and with the balanced 60-65% category, which helps us on our pricing part.
Understood, sir. Thank you.
Thank you. The next question is from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi, sir. Thanks for taking my question. So my first question is if you can give me absolute number for H1 breakup of wheat flour value-added products and also B2B versus B2B sales for first half.
So you need for the entire first half, right?
Yeah.
So Amit this side. So in the first half, the revenue from wheat flour was close to 117 crores, and from value-added flour, which is wheat-based and gram-based flour, it is close to 200 crores. And your next question was on the B2B, right? So the B2B revenue in the first half of this financial year was close to 97 crores.
97 crores. Got it. And a second, only 97 crores? Sorry,
Yeah, 97 crores.
B2B was 97. Got it.
Yeah, B2B. So the B2B includes sale of byproducts and co-products, which is not a focus area for us. Since it comes out during the process of production, we have to sell. We have no other option but to sell it. The majority of the sales, close to 78-79% of the sales is B2C.
B2C. Got it. And so my next question is, you did mention that you repaid some amount of debt, but can I get the gross debt amount as on date?
Currently, the short-term borrowing is close to 58 crores, and there's a long-term borrowing as well in the books, and it is close to 12 crores.
Got it. So 70 crores is the gross debt that we have as on date. And so my last question is, you mentioned that we did buy inventory in bulk, considering the prices that shot up last year. But my question is, what if the prices, start coming down? I mean, like they have in the couple of months, I believe. So, I mean, if the prices go further down, then won't we face pressure again?
So, sorry, your question is, what if the prices go down? The prices go down for me?
Yes. Yeah.
For
RM.
So, right. So it's a very valid question. But then if you see with the advantage of the brand and with the advantage of the pull factor of the consumers, we are in a position to keep our prices the same, even if it is the case the RM prices go down. But to avoid the extremities or the extreme condition of having a disruption in supply chain and margins, which happened last year due to the lesser inventory. So this year, strategically, we wanted to have enough inventory with us to avoid that situation. So if you compare the both situation, it is better to have inventory rather than not to have it.
Got it. Got it, sir. That's it from us. Thank you.
Thank you. Ladies and gentlemen, we request you to limit your question to one per participant. In case for follow-up, please rejoin the queue. The next question is from the line of Aniket from Shubhkam Ventures. Please go ahead.
Good morning, sir. Sir, first,
Good morning.
You did mention about the increase in inventory to safeguard your margins and the pricing, everything. So this is just a one-year phenomena which you have adopted this year, or this is structural in nature? Every year you will do this?
No. This is, I think, it's first of its kind in our business life. And it's a one year strategy. The reason being, till last year, if you see last couple of years, 3 to 4 years post-COVID, government collection of wheat and gram was not up to the mark. So out of 100 million crop every year, government till last year was not in a position, they only procured 22 million. But this year the procurement was nearly 29-30 million. So now government carry forward stock is big enough to come into the picture if any disruption is there in the supplies, which was not there in last year. And that was the reason why the prices increased last year. Now, once this cycle has concluded with the government having a procurement of 30 million, nearly 30 million this year, moving forward, every year government will be in a position now will be in a comfortable position to carry forward the wheat stock, which in return will stabilize the prices in the open market. And I think moving forward, the company or the industry will need not to carry the same high level of inventory.
Okay, so this is not structural in nature. Okay, that is good. And sir, your margins in Sattu are higher or lower as compared to your company average margins?
Higher.
It's higher. So going forward, since Sattu has a low base, so if the growth in Sattu is higher next year compared to your company level, you feel that the margins will improve for the company as a whole?
Of course. So even in the value-added products where the margins is more than 30%, the Sattu itself is one of the highest margin contributor within all the value-added products, which is more than 33-34%. And the next year, if everything goes well, and if we have a growth in Sattu, the overall margins will grow.
Okay, and ultimately your journey towards 11% operating margins by FY28, what would be the main driver? Would it be the product mix, the channel mix, or the operating efficiency, or what would be the main driver?
So in the journey, another couple of years, we look forward to have a EBITDA margin of 10 to 11%, the band of 10 to 11%. And I think it will be a mix of the 3-4 sectors. Primarily, number one, with the advantage of factories near to farm, that is in UP, in Varanasi and Agra, the company is in a position to procure at a lower rate, grind in those areas, manufacture in those areas, and supply directly to our distributors from that areas itself, which gives the advantage on the margin. Now, second, of course, on the pricing discipline, even though there is a intense competition in the markets there, still we would like to have a price discipline which will give advantage to our margins. And the third, as the revenue grows and the penetration of the geography grows, we will having advantage on the margins. And last but not the least, more the revenue grow on the spices in the coming years. And once we attain a scale, we will be in a position to have better margins from spices, which will add to the overall pool of margins.
Okay, sir. That's it, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Naman Maheshwari from Singularity AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. Just wanted to understand that what is the breakup of B2B and B2C in our total revenue in H1?
Hi, Naman. Amit here. So the B2B revenue in H1 is close to 22%, and B2C revenue is close to 78%.
Okay. And second thing, if you can call out, Amit, is that what is the volume growth in H1 in whole wheat atta and the wheat and gram-based products?
Yeah. So the volume growth in H1 in atta particularly is close to 17%, and excluding sattu, the growth in the overall B2C segment is close to 10.1%.
10.1%.
Yeah, and including sattu, the volume growth is close to 7.5% in the first half.
Got it. Second thing which I wanted to understand is that right now our overall market share, 93% of our revenue is from West Bengal, if I'm not wrong. What is our strategy to grow outside of West Bengal, and is there any progress on that?
Yeah. So Amit here. We are targeting to complete and to start manufacturing atta from Agra from the month of November, right? Wherein which will help us to cater to the market of Bihar and Northeast. Our sales team are already working on ground in Bihar and Northeast to onboard new distributors and CNF agents. So we are very hopeful that from the later part of this quarter, which is Q3, we'll be able to increase or penetrate better in Bihar and Northeast. Further, Odisha and Jharkhand, which are the second and third markets for us after West Bengal, we are constantly thriving in those two states.
Just one last thing.
Sorry to interrupt. Mr. Naman,
Yeah.
we request you to kindly rejoin the queue.
Sure. Okay.
Thank you. The next question is from the line of Ganesh, an individual investor. Please go ahead. Mr. Ganesh, we request you to kindly unmute your line.
Hello.
Yes, sir, you're audible.
Okay.
Hi.
The first question is from expansion point of view, and to mitigate the geographical risk, 80% revenue is coming from West Bengal. So are you planning for to diversify? Are you planning for to have your presence in any other geographic or any other state? And if yes, then can you outline expansion strategy, any timeline and priority state or region to scale up? And additionally, if you can focus on what would be the investment for this such scale up and expansion?
Right. So thank you for joining. So as we said, the Eastern India market, overall market is nearly 5,500 crore market of the categories where we operate, and 6,000 crore market for spices which we have entered. But again, Bengal alone is more than 1,500 crore market for the categories where we operate. So I think it's still Bengal, though we are the market leaders in Bengal, it's still a lot of activity or action is yet to happen in Bengal alone. So moving forward, the overall categories of staples is the overall market is nearly 8,000, 5,500, 6,000 in Bengal, of which 18% is only being sold in packaged form. So there's 82% of wheat derivatives and gram derivatives in Bengal alone is being sold in loose form, and the same percentage is being sold loose form in Eastern India. So I think moving forward, the growth to have a higher growth, we will not like to overlook the Bengal, though we are market leaders here. So we will like to go more deeper in Bengal also, as well as we have started our full-fledged marketing initiatives in Jharkhand and Odisha, which is our contributor of our whole revenue as second and third. And with the advent of new facility in Agra, which will have better logistic supply chain advantage for Bihar and Northeast markets. So which we are going to start in November last. So with the help of this entire focus on Eastern India other than Bengal, we are very nascent player as of now. But with the basket size where we operate, with the advantage of the basket size and with the advantage of the supply chain, we look forward to have a good figures and better market share in Eastern India also.
Mr. Ganesh?
Thank you. So I have another question, but I'm from NQ.
Thank you, sir. As there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you very much to all the participants for your interest and for your continued partnership in Ganesh Consumer Products. We look forward to connecting with you once again for our next earnings call for Q3 in the later this year. As we move past the festive season, I would like to take this opportunity to extend warm wishes for the upcoming new year. May it bring prosperity, good health, and happiness to all of you and your families. On behalf of entire Ganesh Consumer Products family, thank you once again for joining us today and showing the interest and trust on us. Thank you.
Thank you.
Thank you. On behalf of Go India Advisors LLP, that concludes this conference. Thank you for joining us. You may now disconnect your line.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.